Good morning, and welcome to our 2025 Annual Review Open Meeting. My name is Lori Belfer, and I'm the Executive Director of the Automobile Insurance Rate Board, or AIRB, as we like to call ourselves. And I will be hosting today's meeting. I would like to start this meeting by acknowledging the traditional territories of the Indigenous people of Treaty 6 region and the Métis settlements and Métis nations of Alberta, regions 2, 3, and 4. The AIRB respects the histories, languages, and cultures of the First Nations, Métis, Inuit, and all the First Peoples of Canada, whose present continues to enrich our community. The AIRB's mission is to independently regulate auto insurance rating programs and educate consumers to ensure that they have access to a robust auto insurance marketplace. Therefore, the information shared today is important as it affects over 3 million drivers and the insurance companies who are actively writing private passenger auto in the province of Alberta. In accordance with the Insurance Act and the Insurance Premiums Regulation, the AIRB must conduct an annual review of the auto insurance trends and premiums for private passenger vehicles. As part of this process, we are holding this meeting to hear presentations from our actuary and our consumer representative, as well as other interested parties about the review of auto insurance and the auto insurance loss experience for private passenger vehicles. We recognize that participation in these meetings varies from year to year, and this year we will not hear from any external parties, and we will only hear from our actuary and our consumer representative, who will share their findings today. Today marks the 20th anniversary of the annual review meeting, and to ensure this meeting is accessible to everyone, we are continuing to hold this meeting virtually. A virtual meeting enables all people and interested parties to participate in our annual review without the cost of travel. The purpose of today's meeting is to review all input and assist the AIRB in analyzing the industry experience to develop the industry benchmarks which are used when opining on the reasonableness of insurer assumptions used in the development and review of rate filings submitted after October 1st, 2025. According to the legislation, we must consider the industry-wide loss costs, administrative expenses, and profitability. This meeting is an important process, and it's an opportunity for industry to hear from Oliver Wyman on how they propose their loss trends and how those were determined. The approved final benchmarks will be posted on our website by October 1st, 2025. So before we begin today's presentation, I'd like to highlight a couple of housekeeping items. So if we can go to the next slide. Thank you. This meeting is being recorded in order to enable those who are unable to attend the live presentation this morning to be able to watch it later. We will be posting the recording of today's meeting on YouTube and on our YouTube channel, which will be there by August 31st. A link will also be shared on our website. Following this meeting, copies of today's presentations will be available on our website at albertaairb.ca. And we request all presenters to mute their microphones when not speaking in order to avoid and minimize disruption and ensure everyone can clearly hear the presentations. So now I'm going to turn it over to our first presenter. If we can go to the next slide. Perfect. And so I want to invite Jalen Reitner and Felix Chan of Oliver Wyman, AIRB's consulting actuary, to present their report, which was posted on our website on June 17th. So with that, over to you, Jalen and Felix.
Thank you, Laurie. We'd like to take a minute before we start to thank the board for the opportunity to present and perform our industry review for them. As we move on to our presentation, as Laurie mentioned, it's myself and Jalen doing the presentation today. Raj, unfortunately, was not able to attend this presentation today, so it'll just be the two of us. And we can jump right into the presentation where we want to take a look at a quick walkthrough of the economic conditions that we've experienced this past year. So on to the next slide, please. And the one after that. So the latest data that we used for our analysis at the time that was available was April 2025, and we can see that over the years from June 19, pre-pandemic, all the way through, there was the spike that we noticed in 2021 on the CPI index, consistent with the period of excess inflation that we see in our loss trends. And when we look at the CPI excluding the energy category, we notice that the CPI is actually a little bit more stable, but we still see the jump in the 2021 and 2022 years. The CPI has become a little bit more stable in the recent periods, and looking at the population growth, we see a continued growth in the population in Alberta, with a slightly higher rate of growth in the more recent years. On to the next slide, please. Looking at the unemployment rate in Alberta, we see that unemployment has generally fallen within the long-term range of 5 to 7%, though it's come up at the top end of the range in the recent periods, which would suggest a potential lowering of frequency. Next slide. Looking at the bond yield rates, interest rates have come down a bit from the highs of the late 2023 and early 2024 period, but they remain above peak levels that we have not seen since early 2008. This should result in insurers earning more investment income to help offset their underwriting profit needs. Next slide. I think we're going to skip over the industry benchmarks and jump right into section 3 here, where Jalen can go over the loss trend benchmarks. And over to you, Jalen.
Thanks, Felix. So if we go to the next slide, please. So this is a high-level summary of where our trend rates are at as of December 31st, 2024, and our prior review as of 6/30. And I think one of the main things you'll see is that a lot of the trend rates are relatively unchanged. There's some minor variations here and there, but for the most part, there aren't a lot of big swings. But there are some differences in how we handled certain issues that came up in this review. And so the two main differences between this review and the prior are our treatment of inflation, which impacts the physical damage coverages. And Felix will go a little bit more in depth into that later. And then higher development, which we noticed on the liability coverages, especially bodily injury, which impacted our severity trends and also the reform scalars. So we're going to start with the development issue. And if we could go to the next slide, please. So this is a comparison of our estimated ultimates and so our frequency, severity, and loss costs in our current review and the prior review. The prior review is the light blue line, and our current review is the black line. And so what I wanted to point out was frequency is relatively unchanged. You'll see some small variations in the recent data points, which is expected. But severity is really where we saw the big difference. And so as of last review, you'll see that the trend kind of was consistent all the way through 6/30/23, whereas now, starting in about 2022, we see this steep increase, and the later periods kind of exhibit this higher trend rate. Now, next slide, please. So the first part before selecting a trend rate is getting to our ultimates, which is the raw or the data that we showed in that last slide. And in our review of bodily injury, we noticed these higher development factors in the recent diagonal. We noticed this last time, however, it was mainly just the latest diagonal, whereas this review, we see two diagonals of this higher development. And so we were able to look into the individual insurer data of some of the large insurers, and we identified two insurers that were really like the main were mainly responsible for this higher development. Um, and so we have a couple options when we see this. One of them is just to exclude that data and look at the industry excluding those two insurers. But in this case, we saw that these two insurers made up a significant portion of the industry written premium. And so we didn't think that was a reasonable solution to this higher development that we saw. So we decided to look at the industry excluding those two insurers and then also estimate the ultimates for those two insurers separately. So that way we could more explicitly recognize the higher development for just those two insurers while not extrapolating it to the entire industry. And so then once we have those three pieces, we combine them together to get to our ultimate loss for the total industry. So that's how we handled it. And if you could go to the next slide, please. This is all to get at really what we care about is the impact of this. Yes, we need to make sure that we're handling it. But at the end of the day, what does this mean? And so really what we're seeing is that the impact seems to mainly be due to our estimated reform scalar. So when we did some costing for the board prior to the reforms, our initial estimate was a minus 18% reduction to loss costs for bodily injury. And this is the first review where we're seeing that the indicated scalar from our models was actually positive. And so in that summary slide a couple slides ago of the trend rates, our trend rate came down from 9.1 in our prior review to 8.7% in the current review, but the scalar is now higher. So there's some commingling going on, and some of the reform might be picked up in the trend. And so we're seeing a lower trend rate, but not the same reform scalar. But really what we want to drive home is that there's a lot of uncertainty with these points because of this development issue. And so we made an attempt to recognize this and fit it in our models, but there's a lot of uncertainty with our bodily injury loss cost. The other point that we wanted to drive home is that with the Care First reforms that are coming in 2027, some of these bodily injury costs may go away. So there's that background to keep in mind when going through this analysis. I'll note that this issue also applies to accident benefits. However, it wasn't to the same extent, so we didn't go through the process of or separating those two insurers, but we did consider the development issue in our accident benefits selections. And so with that, I think we're going to skip forward to section 4, and I will pass it back over to Felix. I think you're still muted, Felix.
Sorry about that. Thanks, Jalen. So as I was saying, I'm going to jump over to the inflation section. As we noted in our review, there was a period of excess inflation, and we just want to go over our view of the inflation and how we handled that. So on to the next slide, please. When we look at the inflation and we look at the CPI indexes, looking at the right side of the slide, the graphs are showing large increases in property damage, collision severity, and to a lesser degree, bodily injury. So under our data-based approach, we try to include an additional parameter to isolate and quantify the impact of this excess inflation in our models. In the last few periods, we do see signs that the excess inflation appears to be behind us, with a flatter trend that's starting to emerge. Next slide, please. So now when we look at the consumer price index for inflation, we're looking at a few different CPI metrics for different categories to kind of look at the implied inflation rate for our industry trends. And we're looking at, on the left side, the yearly rate of change, and on the right side, the graphs are showing, sorry, on the left side is the CPI data, and on the right side is the yearly rate of change. Sorry about that. I don't want to jump into too much detail on this one because it is just about all items in transportation. So if we go on to the next slide, we'll drill a little bit deeper on the transportation items of the private passenger vehicles, which is the cost to purchase or lease a new vehicle, as well as the bottom graphs, which are representing the cost for renting a vehicle. So similar to the prevailing theme of excess inflation, we see the spike beginning in it. The graph is a little bit hard to read, but I will just kind of describe it. We do see the spike beginning in 2021 with a return to moderate inflation in 2023 for these two categories. And then on to the next slide, where we look at parts and maintenance, so the cost of repairing and maintaining a vehicle, as well as healthcare, which is more focused on the rising healthcare costs and the accident benefits coverage. And we see the same thing here with a faster rate of inflation in 2021 for the vehicle parts and maintenance, and the healthcare CPI metric, although it's a little bit difficult to see, it does lag behind by about one accident semester where the spike happens, which is consistent with our review of these coverages. Next slide, please. So on the previous slides, we showed how the CPI metric tracks over time, and here we're showing how the severity has changed for each major coverage. The points in red are visually there to separate the other points, and they indicate a 10% increase. And that's just to provide a frame of reference of what those points represent. The vertical line in the bottom two graphs represent the timing of the inflation spike that we see, and consistent with our review, we see the spike in bodily injury. It's not as apparent in accident benefits. And then if we look at the other coverages on the next slide, we do see the spike as well, a little bit in property damage and very pronounced in collision, but not so much in comprehensive. And our theory there on the comprehensive part is that comprehensive is a little bit more volatile because it is affected by catastrophes and the persistent theft issue that the industry is working hard to tackle. Next slide. So how I've spoken so far about the inflation and the severity behavior, and how does that affect our loss trends now? In the past, we've tried to address severity changes through a number of different methods. The two most common methods would be a scalar, which aligns with our view that the effect of the excess inflation is temporary, but it also assumes that the excess inflation level is constant during that period of excess inflation. And the second way we've handled this in the past was through a trend parameter change, and that aligns well with the compounding nature of inflation, but it also assumes that the high inflation level will continue into the future, which may not be a reasonable assumption. This year, we took a different approach and looked at the CPI categories I mentioned in the previous slides and how they compare to the baseline CPI changes for those categories over time. We try to do this to isolate the impact of the excess inflation, similar to how our mobility parameter attempts to isolate the impact of the COVID pandemic. Using this, we can measure excess inflation separately for physical and non-physical damage coverages and address the shortcomings of the other methods I've mentioned. Namely, the excess inflation is not constant over time, and we do not expect the high excess inflation environment to continue indefinitely into the future. Next slide, please. So here on the right side, we see the excess inflation adjustment factors that we've derived through the method I just described. And on the left side, visually, what we're seeing here is a representation of the excess inflation. The red dots would represent the environment if inflation had continued on its normal course, with the black dots showing the elevated results of excess inflation. And next slide. For future loss considerations and how we think it should apply to future trends, the main takeaway is that excess inflation did occur. The impact of excess inflation on an individual insurer may be different. So insurers should only consider an adjustment to the extent that they feel their loss experience was impacted by this. And they should also definitely provide relevant support for these adjustments in their filings. Lastly, we want to caution insurers on how they adjust for excess inflation so they aren't extrapolating this into their future trend periods. I will now pass it over to Jalen to talk about the reforms and the combined new normal adjustments.
Thanks, Felix. So if we could go to the next slide, please. So in our analysis, there are two reforms that kind of impact four coverages that we considered in our analysis. So Bill 41 is the first, which impacts bodily injury and accident benefits. And I will again point out, keep the development issue that we discussed earlier in the background as we go through this, because that has an impact on our findings. So for bodily injury with Bill 41, our methodology has been to include both a reform scalar in our frequency model as well as in our severity model. And historically, what has happened was that we found the frequency scalar has been negative, the severity scalar has been slightly positive, but the combined impact, as well as the scalar in the loss cost model, is negative. Now, it has been increasing closer to 0%, so it's been getting less negative compared to our initial estimate of -18%, but it has been negative. As I pointed out earlier, this is the first review where the indicated scalar has been positive. And so that's what our model implies, but we also need to think about what was the reform, what actually changed, and what our conclusion was that a positive impact to loss cost because of the reform wasn't reasonable. There might be some commingling with other factors that's going on that's causing our model to think that the impact was positive, but we don't think it's reasonable to put a positive scalar out there as an impact of the reform. So for this review, we selected a reform scalar of 0%, whereas 6 months ago we were at -4.7%. So like I said, we've been getting closer to 0 from -18, and now we're at 0. But we do want to acknowledge the fact that our model might be commingling the reform effects with some other impacts. And on the next slide, I'll get back into this with our model. But for accident benefits, we see our prior estimate of the reform scalar came down. For accident benefits, we only include a reform scalar in our severity model and not in our frequency model. Our initial estimate for accident benefits was +8%. So you'll see last review we're at plus 16, double what our initial was. Now we're back down to 11.6%, so a little closer to the 8%, but there's a lot of volatility there. And so we will continue to estimate this as more data comes out. But again, the Care First reforms are coming, and so the bodily injury and accident benefits product is changing. So we'll only have a couple more years of estimating Bill 41. And then we have the introduction of DCPD in 2022, which through our analysis, we're finding that there seems to be an impact to both DCPD. Right now, we include DCPD with property damage. So we have this total PD and then collision, where there seems to be some transfer of claims from collision to DCPD. And I'll show you a graph of that in a couple slides as well. But if we can go to the next slide, I'll show our models for property or for bodily injury and accident benefits. And so again, really what I want to point out is that there's a lot going on for bodily injury. If you look just in our loss cost model, there's COVID, there's the reforms, there's inflation, there's the development issue that we discussed earlier, all going on kind of in the same period, all of that 2020 to 2024 time period. And so we have these four effects going on in really these 4 years or 8 data points. So there's a lot of commingling going on where our model might pick up some impacts in one variable that should be in another. And so that's to say it might be possibly masking the true impact of the reforms, which was our reasoning for judgmentally selecting a 0% reform scalar after seeing what our models output. And then for accident benefits, you'll see I'll mainly point to the severity model because that's where our reform scalar is. We see a slight bump in 2020, so we see that scalar, and then we've seen that the severity trend has leveled off a little bit. So it was up toward 12% prior to the reforms and is now down to 7%. So it's flattening off a bit. So if we can go to the next slide, please. We'll shift to DCPD a little bit. And so this is a graph showing frequency for collision, total property damage, and then combined. And so the black line is the combined. And what I'll point out is that you'll see that during COVID, we see this drop, and then we get to this new normal, so 2023, 2024, where the frequency level is lower than pre-pandemic. And so if we look at the total, we kind of get rid of that shift from collision to property damage because we're looking at the pool of claims. And so that shift from collision to property damage doesn't have an impact because it's included in both. And so what we found is that there does seem to be a COVID and new normal impact on the combined. But if we look at, so property damage is the light blue line, we'll see that in 2023 and 2024, there seems to be no new normal impact. So we're back up to where we were pre-COVID. And then collision, which is the lighter gray line, is now way down from the frequency pre-pandemic. And so we'll get into the actual factors in a couple slides, but there appears to be some COVID impact that's affecting both that we can see in the total line, but some claims are getting shifted from collision, causing collision to be way down and property damage to be back up to where it was pre-pandemic. And so this is just something additional that we need to estimate and consider when we're selecting our models. So if we can go to the next slide, please. So again, getting into what does this mean? How does this go forward in rate indications and what we put forward to industry? So stay-at-home orders, obviously, as everybody knows, during COVID, the frequency during these 3 years is much lower. And so when projecting forward, we need to bring those years up. Bill 41, we see a reduction in bodily injury, accident benefits, possibly not so much as we don't have a scaler in there, but these two we need to consider, mainly bodily injury for frequency. And then the introduction of DCPD, which I just went through last slide, where property damage seems to be back up, or total property damage seems to be back up to where we were pre-pandemic, but collision seems to be way down. And so when considering these, we come up with this combined new normal factor. And we call it this combined new normal factor because, as I said earlier, there's so much going on. And so we have these individual parameters in our model where we can try to separate out the individual impacts of each effect. And so we can do that with some certainty. But at the end of the day, the combined impact is what really matters. And we can look at the combined impact with more certainty than the individual components. So if we say, for example, during 2020, there was a 20% total reduction, and our model might estimate that 75% of it was due to COVID and 25% of it was due to reform. That helps us, the breakout, but there might be some commingling in our model where really it should be 60-40 or 50-50 or whatever. But we can be more certain about the combined impact where the components don't matter as much as the combined impact. And so the next couple slides we'll go through and really just look at what these factors mean for projecting to a 2024 cost level. So if we can go to the next slide, please. So here's for bodily injury. And what you'll see is that we see this drop during COVID, but then we've also seen this kind of sustained drop from the pre-pandemic frequency. So we get this almost 25% decrease, which you'll see in that prior adjustment factor, which applies to all periods 2019-2 and prior. And then during COVID, we get some of these periods that need to be increased. 2021-2 and 2022-1 are kind of right at that level. So there's a small adjustment, but they're basically at this new level. If we can go to the next slide, please. For property damage, this gets back at what I was saying with a return to the pre-pandemic frequency level. So we see this drop during COVID, but then now we're basically back to pre-pandemic. So we don't really need to adjust pre-2019 because we're back to that level. So we just need to bring those low COVID points back up to get us to where we are at in 2024. Next slide, please. Accident benefits is a pretty similar story to bodily injury. The new normal frequency level isn't as low. So bodily injury was about 25% lower. Accident benefits were only about 5% lower. So slightly lower than pre-pandemic, but not to the same extent that we saw for bodily injury. But we still see these low points during COVID that need to be brought up. And then finally, if we can go to the next slide, collision here is the opposite end of the property damage issue that I was talking about. So you'll see these low COVID points, but now for collision, we're about 35% lower than pre-pandemic. So whereas property damage is back up, collision is way down. And so it appears to us that there's some transfer of claims from collision to property damage. And I think that is the end. So a very rare occasion, but we will give some time back to you, Lori, unless you have any questions for us.
No, thank you very much, both of you, Jalen and Felix. It was great to hear your highlights of the presentation, and just for the guests on viewing the video or in attendance today. The full deck will be shared on our website later today. We do appreciate your overview of the BI loss trends and the changes we're seeing there, as well as the impact of inflation and the new normal. So great presentation, very much appreciated. So
Thanks,
with
Lori.
that, we are going to move on to our next presentation, which is to hear from our consumer representative, Kathy Manton. So with that, I'm going to give it over to you, Kathy.
Great, thank you very much. Good morning, everyone. I am pleased to present the 2025 Consumer Survey highlights on behalf of the Automobile Insurance Rate Board. This annual survey helps us understand how Albertans perceive the auto insurance system, what's working, what's not, and where we need to focus our efforts. Let's dive into the key findings and what they mean for consumers, insurers, and policymakers. We asked Albertans to name the government body responsible for regulating insurance rating programs. The responses were very eye-opening. Some named political figures like Justin Trudeau. Others mentioned private companies like Hub International. Only a small portion correctly identified the AIRB. This is the second year we have asked the question. While aided and unaided awareness rose by 3%, a good result for our first campaign, it's clear that our education campaigns have not yet broken through. We asked Albertans how confident they feel when making auto insurance decisions. The results show no significant change from last year. Confidence remains high, especially among those aged 55 and older. While confidence is good, it can be misleading if not paired with knowledge. High confidence and low literacy can lead to poor decisions, like overpaying for coverage or misunderstanding policy terms. This reinforces the need for consumer education that empowers people to make informed choices. One of our key questions each year is whether people feel their insurance costs are fair and reflect their driving habits and vehicle type. This year, agreement with that statement jumped by 10 percentage points. This is surprising, especially given the media narrative around rising premiums. One possible explanation is that Albertans expected worse increases and were relieved to see them capped, thanks to the Good Driver rating cap and the AIRB's policies to control rates. Those aware of the AIRB and the cap were significantly more likely to agree that their rates were fair, showing how our awareness can shape perception. Despite being in place for 2 years, awareness of the Good Driver rate cap remains low. This is concerning because insurers are required to notify policyholders about whether they were capped. The low awareness suggests either the communication is not effective or people are not reading their insurance documents, or both. Again, this points to a need for clearer, more engaging communication from insurers and regulators alike. This year, we introduced a new question. Do Albertans believe that auto insurance providers act in their best interest? This is especially relevant as we prepare for the Care First reforms, which aim to shift the culture of the insurance industry towards more consumer-focused care. The results show a trust gap, especially among those unaware of the AIRB. This baseline will help us track whether the reforms are improving public trust over time. We explored consumer experiences with purchasing insurance, including unexpected premium increases and denial of coverage. Young Albertans, 18 to 34, were more likely to report both decreases and denials, suggesting a more volatile experience for this group. Alarmingly, some respondents said they chose not to insure their vehicles at all, which raises serious concerns about affordability and access. These findings highlight the importance of ensuring fair treatment and transparency across all demographic groups. We asked whether consumers contacted their broker or agent to understand why their premiums increased and whether they were satisfied with the explanation. Satisfaction was notably higher in rural areas than in Calgary. This suggests that brokers in urban areas may need more support or training to effectively communicate with higher volumes of clients. It also underscores the importance of clear, accessible explanations for premium changes. We looked at whether people had switched insurance companies in the past 2 years. Younger consumers and those aware of the Good Driver rate cap were more likely to switch or obtain new policies. Older and rural consumers were more likely to stay with their current provider. This shows how awareness and demographics influence consumer behavior and how competition in the market may be driven by younger, more informed consumers. We asked about awareness of the Care First system and whether people believe it will improve affordability. Awareness is still low, especially among younger Albertans. However, younger respondents are more optimistic about the system's potential benefits. Those aware of the AIRB and the rate cap were also more likely to support the Care First approach. This suggests that as an awareness grows, so too might public support for reform. Thank you for your time and attention today. If you'd like to learn more or get involved, please visit our website or contact us directly. We're committed to making Alberta's auto insurance system more transparent, fair, and responsive to consumer needs.
Thank you, Kathy. On behalf of the AIRB, I want to thank you, both you and Jalen and Felix, for the presentations today. I know, Kathy, from the board meetings, the consumer perspectives is always top of mind when we're discussing anything with respect to rating programs or any of the activities that we are entertaining to engage on as an organization. So very important for us to have that perspective for sure. So now we have concluded today's presentations, and on behalf of the AIRB's Board of Directors and staff, I would like to extend thank you to everyone who was in attendance. We will finalize the industry benchmarks, which will be used in our review of industry rate filings submitted after October 1st, 2025. The benchmarks will be used to assess the reasonableness of insurer assumptions and their data, and where we do expect insurers to use their own data, but where their data is not credible, then they would use supplement with the AIRB benchmarks. And where we feel that the insurer's results vary significantly from our benchmarks, we will ask additional information as well as additional questions in order to understand the variances. We encourage everyone to follow the AIRB on social media to stay up to date with the great work that we are undertaking, and as well to learn more about trends in the industry and to be reminded of safe driving tips. And again, I would like to thank everyone for their presentations, and this meeting is adjourned. Thank you.